Some of the riskiest multifamily deals I see in 2026 don't look risky at all. The numbers look fine, the pricing makes sense, and the renders look clean. That's exactly why they catch investors off guard. In this video, I want to show you why deals fail in balanced markets even when the math looks right, what risks never show up in pro formas, and what experienced investors look for before committing capital. If you're new here, welcome, and if you've been following along, I appreciate you being here. Most investors watching this aren't trying to swing for the fences. You're trying to avoid mistakes that don't show up until it's too late. That's what this conversation is really about. In hot markets, a lot of mistakes get hidden. Rising prices cover delays, appreciation masks inefficiency, and weak execution gets forgiven. Balanced markets don't do that. In 2026, issues surface immediately. Delayed timelines, missed assumptions, weak coordination, sloppy execution. These things don't appear in spreadsheets, but they absolutely appear in real life. And when they do, they stress financing, cash flow, and investor confidence all at once. This is why builder quality matters more now than it did a few years ago. Not just how long they've been around, but whether they've actually delivered multifamily projects like the one being proposed. In 2026, the builder controls timelines, controls execution, and directly affects financing outcomes. You're not just buying a building, you're backing the operator building it. One of the biggest misconceptions I see is this. People think CMHC issues happen at underwriting. They don't. Most CMHC problems are baked in much earlier, at design, unit mix, layout efficiency. If those are wrong, no amount of financing creativity fixes it later. By the time CMHC reviews the deal, the risk is already there. A lot of investors chase lower build costs thinking that means lower risk. Often it's the opposite. Cheaper builds are usually less forgiving when timelines slip, costs move, scrutiny increases. In balanced markets, durability matters more than speed, and execution matters more than headline pricing. In this market, price doesn't kill deals. Execution does. That's why in 2026, execution is an investment. And if this way of thinking resonates with you, if you're trying to avoid problems that don't show up on spreadsheets, there's a link below where you can learn more about how I work with investors and whether it makes sense to have a direct conversation. No pressure, just clarity before capital gets committed. See you next week.